This is Trade Alive with IUX, where markets come alive and trading gets real. Let's go live.
This podcast is brought to you by IUX Trading Platform, elevating your trading experience.
Hello and welcome to the IUX Podcast, where we explore the critical intersection of market strategy and human psychology. Have you ever found a trade setup that looked absolutely perfect? The chart aligned, your favorite indicator gave a crystal clear signal, and you just knew with 100% certainty that it was going to be a winner? You felt it in your gut. It was almost like a premonition. You felt so confident that every article you read that morning, even neutral ones, seemed to support your thesis. You went looking for news and found 3 headlines that confirmed your direction. But then, in your excitement, you completely missed the contradictory bearish divergence signal on the 4-hour time frame. Or you saw that a major news event was scheduled, but you dismissed it as just noise, telling yourself it wasn't important or was already priced in. Suddenly, a trade that felt like a sure thing is deep in the red. You feel that hot, sick feeling in your stomach. You're staring at the P&L, refreshing the screen, willing it to turn around. You're left confused, angry, and wondering, what went wrong? The setup was perfect. If this sounds familiar, you're not just not alone, you are a normal human being. This is perhaps the single most expensive, most common, and most destructive habit in a trader's psychological toolbox. This is a powerful psychological phenomenon, and it's the focus of our discussion today. We're asking the question that forms our long-tail keyword: why traders only see what they want. This isn't a character flaw, it's not a sign of low intelligence, and it doesn't mean you're a bad trader. It's a fundamental, non-negotiable feature of human cognition. It's called confirmation bias. Think of it as a bug in our mental software. Our brains are running an operating system that evolved for survival in a simple, linear world, but we're trying to run the most complex, non-linear software on the planet, the financial markets. This bias causes chaos. In this episode, we'll break down what it is, the deep psychological reasons why it exists, how it directly manifests in your trading account, and, most importantly, the practical system-based tools you can use to fight it. We're not here to judge, but to understand so we can build better habits. To start, let's get a clear academic definition. Confirmation bias is the human tendency to actively search for, interpret, favor, and recall information in a way that confirms or supports one's pre-existing beliefs or hypotheses. This isn't malicious. It's not a conscious choice. It's a built-in efficiency filter. Our brains are processing millions of bits of data every second. It's as metabolically impossible to analyze everything equally. So our brain creates shortcuts or heuristics, and one of the primary shortcuts is to favor information that fits our existing mental models and to discard information that doesn't. Think about it outside of trading. If you believe a certain brand of car, let's say brand X, is unreliable, you will actively and unconsciously notice every time you see a brand X car broken down on the side of the road. That image will stick in your mind as proof. You won't, however, notice the thousands, literally thousands, of that same car that drive you by flawlessly every single day. Your brain filters reality to match your belief. Now, let's apply those 4 parts of the definition directly to trading. Actively search for. You have a bullish idea. You don't Google arguments against my trade. You Google why currency pair is going to the moon. Interpret. Neutral news, like a jobs report that's just okay, is interpreted as great news. The economy is strong, so the currency will go up. Favor. You give more weight to the one indicator that confirms your trade, like a MACD cross, while dismissing the 2 indicators, like a bearish RSI and being below the moving average, that contradict it. And recall. You remember your past wins with crystal clarity, but conveniently forget the losses that were caused by this same bias. At the same time, we tend to ignore, devalue, or become actively hostile toward information that contradicts our beliefs. In trading, this means if you are convinced a currency pair is going to go up, you will unconsciously start looking for all the bullish signals while simultaneously filtering out, explaining away, or just plain not seeing all the bearish signals. It's a mental shortcut that can be disastrous when real money is on the line. So why do our brains do this? The first major driver is a powerful concept called cognitive dissonance. This theory, developed by psychologist Leon Festinger, describes the intense mental discomfort, a feeling of static or an itch in your brain when holding two or more conflicting beliefs, values, or attitudes. Our brains hate this conflict and will do anything to resolve it. For a trader, that conflict looks exactly like this. Belief 1, I am a smart, analytical, and diligent trader. I did my research. I am good at this. Belief 2, the market, an objective force, is moving against me, which implies my analysis was wrong. This in turn implies I am not smart or good at this. These two beliefs are in direct, painful conflict. This creates intense psychological discomfort. To resolve this dissonance, your brain has two choices. Choice A, change belief 1. This means accepting. My analysis was flawed. I made a mistake. I need to reevaluate my skills and my self-image. This is painful, requires humility, and uses a lot of mental energy. Choice B, change belief 2. This means rejecting the new information. The market is wrong. My analysis is correct. This is just manipulation, or it's just bad luck, or it's just noise before the real move. This is easy, fast, and most importantly, it protects your ego. Your brain, as an efficiency machine, will almost always choose the path of least resistance. It will choose choice B. It will protect your ego by filtering reality. This is where the real danger comes in. You dismiss the losing trade as market manipulation rather than accept your analysis was flawed. But it goes further. You might even start adding to the losing position, a behavior known as averaging down. Why would anyone do this? Because averaging down is not a financial act. It's a psychological act. It's an act of reconfirming belief 1. You are essentially screaming at the market, I am so smart and so sure I'm right, I will buy even more at this discounted price. You are trying to force the market to agree with you to resolve your internal dissonance. The second driver, the cost of being wrong, ego and sunk cost. This ties directly to the second driver, our ego and the sunk cost fallacy. The sunk cost fallacy is the tendency to continue a behavior or endeavor as a result of previously invested resources. In other words, the more you invest in something, the harder it is to abandon it, even if it's clearly a failing idea. When we talk about costs sunk into a trade, we're not just talking about the money. We're sinking in multiple forms of capital. Time capital. You spent 3 hours last night researching this trade. You backtested it. You've been watching it for 2 days. Intellectual capital. You're proud of your analysis. It was a smart idea, a clever thesis. It's part of your intellectual identity. Emotional capital. You got excited about the trade. You felt that rush of adrenaline. You already mentally pictured the profit and what you do with it. Social capital is a big one. Perhaps you posted your trade analysis in a forum or told a friend or partner about your great idea. Now, when the market turns against you, your ego feels attacked on all 4 fronts. You don't want to admit that your time was wasted, your smart idea was wrong, your excitement was foolish, and worst of all, that you were wrong publicly. The cost of being wrong feels exponentially high. Instead of objectively viewing the new price action and taking a small, disciplined loss, we double down. We hold on to the losing trade, hoping it'll turn around. We are no longer trading the market. We are trading our need to be right. We are trading our sunk costs. This is a primary reason why traders only see what they want. They've already paid for their opinion with time and ego, And accepting a loss means accepting that all that investment was for nothing. So how does this look in practice? Recognizing these symptoms in yourself is the first step to fixing them. Symptom 1, cherry-picking indicators. You might use 5 indicators in your system. 4 of them, the RSI, the moving averages, the stochastics, and the Bollinger Bands, are all screaming, sell. But one indicator, your pet indicator, like the MACD, gives a very weak, borderline buy signal. The confirmation bias leads you to focus entirely on that one bullish signal. You tell yourself, the MACD is the most reliable one, and you dismiss the other 4 as lagging, noise, or not relevant in this market. You're not using indicators for analysis. You're using them for validation. Symptom 2, biased news interpretation. This is a classic. A neutral economic headline comes out. For example, jobless claims slightly higher than expected. If you are in a long position, bullish, you will interpret this as, great, this means the Fed will have to cut rates to support the economy, which is bullish for stocks or risk assets. If you are in a short position, bearish, on the exact same pair, you will interpret the exact same headline as, see, the economy is weak and falling apart, bearish. The news itself became irrelevant. Your bias is the filter through which all information must pass. Symptom 3, seeking echo chambers. This is one of the most dangerous symptoms in the modern age. You take a trade and it starts to go against you. You feel that dissonance. So what do? You actively go to a forum, a Twitter feed, or a social media group where you know other traders share your same bullish or bearish view. You're not looking for an honest debate. You're looking for validation. When you see 20 other people agreeing with your flawed analysis, it no longer feels like an opinion, it feels like a fact. This creates a feedback loop that reinforces your bias, making you feel more confident in a worse position. Symptom 4, biased recall of past trades. This bias also rewrites your memory. When you think back on your trading history, you will naturally remember your great calls with vivid clarity and detail. But the trades where you got lucky or the ones where you ignored your plan and it happened to work out get filed away as skill. The many losses where you did the exact same thing are often blamed on bad luck or manipulation. This biased memory convinces you that your gut feel is much more accurate than it actually is, leading you to trust your flawed, biased feelings more in the future. To summarize, the question of why traders only see what they want isn't a mystery. It's a predictable pattern of human psychology. It's driven by confirmation bias, which is fueled by our brain's desire to avoid the discomfort of cognitive dissonance and to protect our ego after we've invested time, energy, and hope into an idea. So, how do we fight this? This is the most important part, because awareness alone is not enough. You cannot outthink a bias. You must have a practical, non-negotiable system to make it irrelevant. 1. Actively play devil's advocate, the pre-mortem. Before you enter any trade, you must force your brain to engage with the opposing view. Make this a mandatory part of your journal. Write down, my bullish case. Then create a new heading that says, my bearish case. Force yourself to find 3 specific, data-driven reasons why the trade could fail. Go find the chart on a different time frame that looks bearish. Find the indicator that is disagreeing. You must force your brain to see the other side before you have money and ego on the line. 2. Make your trading plan 100% objective. Your trading plan should be a rigid, mechanical checklist. A good plan is one that a 10-year-old could follow. If the 50 MA crosses above the 200 MA and the RSI is above 50, then I buy. A bad plan says, buy when the trend looks strong. One is objective. The other is a blank check for your bias. Emotion lives in the vague, subjective words. Your job is to eliminate all subjectivity and become a yes-no execution machine. Your job is not to have an opinion. Your job is to execute the plan. 3. Use a trading journal for emotional accountability. A journal is the ultimate tool for accountability. It's a mirror that reflects the cold, hard truth. Don't just log your entries and exits. Log your emotions. Add a mandatory field, emotion before trade. FOMO, bored, patient, angry, confident, and emotion after trade. Regret, satisfied, revengeful. When you review this at the end of the week, you can't hide from your biases. You will see, took 5 trades, all 5 were angry or FOMO. You can see the pattern and actively work to fix it. 4. Add a bias check cooldown. Never enter a trade the instant you see a setup. Implement a mandatory 5-minute cooldown period. This is a pattern interrupt. The instant you see a setup, you must stand up. Walk away from the desk. Get a glass of water. Look out the window. This physical separation breaks the hypnotic spell of the chart. It allows your rational brain, the prefrontal cortex, to catch up with your fast, emotional, impulsive brain, the limbic system. During these 5 minutes, you ask yourself the one key question: am I seeing the market clearly, or am I seeing what I want to see? Ultimately, successful trading isn't about being right on any single trade. It's about being objective and profitable over the long term. The first step is acknowledging that our brains are wired to see what we want, and the second is building a robust system to ensure that we see what is actually there. If this episode gave you valuable insight, you can click like, subscribe, follow, and share it with another trader who might need this reminder. In the next episode, we'll dive even deeper and explore more. Thank you for listening. See you in the next episode. Goodbye.
You've been listening to Trade Alive with IUX. Ready to put these insights into action? IUX is here to power your next winning trade.